Welcome everyone to our educational web series where today we're focusing on real estate financing and mortgages. My name is Andrew Benetti. I'm one of the financial planners here at CCR Wealth Management. And today we're joined by George DiGregorio. He's a licensed mortgage broker with Zenith Mortgage Advisors in Hopkinton, Mass. George, thanks for joining us today. Please tell us a little bit about your practice and your background.
All right, well, thanks for having me, Andrew. As mentioned, my name is George, and I'm a mortgage broker in Hopkinton, Massachusetts. I've been working as a mortgage professional for 24 years, working for lenders and banks and brokers, pretty much doing the same thing, just under different mantles. But I've been doing this in Massachusetts since 1996. And we have a shop in Hopkinton, and we work with a portfolio of different lenders, and we lend in all of Massachusetts as licensing is state specific.
Great, thanks. And thanks again for joining us. Would you be able to give us an overview of the current mortgage and or refi market? I know that a lot of our clients are certainly hearing that rates are very low and wanting to look into that. So what's your take on that?
As you know, the world is a little bit sideways right now, so things are ever changing, but we're looking at a rate environment like we've never seen before. When I first started doing this in the 90s, we had just come out of double digits into single digits, and people were thrilled to get single digit rates. And now we're approaching, we're at the historic lows. The rates are just ridiculously low right now. So even if you've refinanced in 2020, it still may be worth refinancing again, which is something that we don't typically see. There are a lot of things that are contributing to it, but the yields on bond market are so low that the mortgage rates have been driven down. And what that's doing is it is creating sort of a bottleneck because so many people are refinancing. The infrastructure, so the machine, so to speak, can only take in so much. So some things are taking a little bit longer, particularly appraisals. But on that note, we're getting appraisal waivers on a lot of transactions where we submit the file through an automated underwriting system, which isn't anything new. We've been using this since the mid-90s. And it'll come back and say no appraisal needed. So the majority of our transactions for refinances aren't even requiring appraisals. If they are, they're taking a little bit longer than normal. Usually you get an appraisal back in 5 to 12 days, and now we're seeing double that in some cases. So it's been an unusual year. Underwriting guidelines have changed with regards to COVID. We have different layers of things that have happened. I've spoken to other people that work at different mortgage companies that have completely shifted how they do certain things, where they're looking at people wanting longer contracts to purchase or not taking self-employed clients if they don't meet certain criteria. So it is definitely unusual. We're tightening up a little bit more on the employment verification piece because people unfortunately getting laid off, they're getting furloughed. So it's definitely a challenging environment, but we're still plugging along here. Things are moving pretty quickly on some fronts.
Good. Not surprising to hear that it's a little atypical.
Yeah, there's a lot of automation now so if a loan's pretty straightforward, it'll close quickly. If there's anything slightly out of the ordinary, that will sort of drag it down a bit. For the most part, we're still turning things around pretty quickly. But in the purchase market, it is a seller's market. There's not a lot of inventory. Even in this climate where you would think that people wouldn't want to be going into open houses and things like that, I'm still seeing physical lines of people outside of houses to go in and check them out. If something's priced appropriately, it moves quickly. There aren't a lot of houses sitting around in the market. So we're seeing a lot of activity there. A lot of my clients getting frustrated with, going in on a high multiple offer situation. They're going in high and still getting outbid. So there's a lot of competition out there, and they're expecting it to get busier for 2021. And what I tell people is, like, if you're thinking of selling your house, you need to work on that now. Like, the spring market doesn't start in April. The spring market actually starts December, January. You need to get your house ready to sell, put on the market in February to be sold April or May. So if people are considering getting their house, prepped for the spring market, you got to start now. Even though the holidays are coming up, you really, if you're through January, you're late. You got to get going on it.
Got it. Interesting. Well, so I was going to ask you if people are interested in maybe either refinancing or if they're going to be buying, what would you recommend they should have prepared when meeting with you or another mortgage professional?
Get organized, get your docs together. For your average W-2 type of employee, it's usually going to be pay stubs, W-2s, bank statements. So you want your actual pay stub, whether it's a scanned copy, a fax copy. They don't want to see, your deposit in your bank account. They don't want to see a screenshot from your phone. They want to see the actual pay stub because there's a ton of data in there that they're looking at. They're looking at year to date. They're looking at anomalies. They're looking at people that may be furloughed. So it's going to be your actual pay stub. And your W-2 is the little postcard size thing. Sometimes it's a full sheet of paper, but it's the document your employer gives you that says how much money you made last year. And usually going to get 2018 and 2019. You usually don't need your tax returns. If you're not self-employed and you don't have rental property and you don't have anything that would require a tax return, they're not going to want to see your 1040. So that's a very common thing. I'll ask someone for a W-2, and it's a failing on my part to not be specific enough about it, and they'll send me their tax return, which we can't use. We have to get that W-2. And then you usually don't want to see a bank statement, 1 or 2 months. 2 months is safer. And by a bank statement, I mean your actual bank statement from the bank, whether it is a PDF you downloaded from the website, or it's the one that shows up in the mail and you fax it or scan it. They don't want to see screenshots. They don't want to see history printouts because, again, there's a bunch of data that's stripped out of there. On refinances, it's not as big of an issue, but it is the #1 cause of delays on purchases are not supplying proper bank statements or having things going on in the bank statements that aren't going to meet the underwriting criteria.
So not texting you a picture of a screenshot.
Yeah, screenshots don't work. A screenshot of from their phone, from their computer. It's so picky. It's like a chain of evidence. So if someone's buying a house and I have their October, November bank statements, and then they wrote their down payment check that cleared December 2nd, and they show me the canceled check, the underwriter is going to say, okay, what happened from the end of November through the day that the check was cashed? And the past people could go into the bank, they could get a stamped printout, but a lot of banks aren't accepting live people, or they're having them come by appointment only. So that's been a bit tricky. I guess if you're going to buy a house and your money is spread all over the place, consolidate it long before you want to actually buy a house, because you'd be amazed how much time that causes things to be delayed, because you have 7 or 8 different accounts and you're moving all the money in. That's all going to be paper trailed, all of it, and it can turn into hundreds of pages of bank statements. I know that sounds a little over the top, but you'd be amazed how many people have 7 or 8 statements and the money's going in and coming out. So if you come in with a bank statement, if you need 20 grand to buy a house and your statement shows you have 30 in there, it started the month that way and it ended that way, you're going to be fine. If it has a bunch of $4,000, $5,000, $6,000 deposits, all that has to be back traced. It can be very time consuming.
Got it. Well, we're talking a lot about, different accounts and different statements and tax forms. As you're gathering all that stuff, maybe tell us a little bit about what you or a bank weighs mostly during the pre-approval or the mortgage process. Are there any special considerations given to income versus portfolio assets, W-2 employee versus 1099?
It's pretty much a formula. If you go to work, you pay your bills, you spend within your means, you're going to be able to get a mortgage. And by that, I mean, if you go to work, meaning you have 2-year job history, even if that's been broken up here or there, we can still make that work. And the part where it said, do you pay your bills, your credit report, they can look at your credit to make sure you've managed debt properly in the past. If you paid cash for everything and don't have any credit history, that shows that you can manage your money, but it doesn't show that you can manage debt. And that's the big difference between people that pay cash for everything and people that have financed. You've shown the ability to manage payments. And spending within your means, that means there's a limitation on what you can borrow. As a rough number, call it 45% of your gross income. So if you make 120 grand a year, you make 10,000 a month gross. They really don't want your bills to be more than 45% of that. And debt, I should say, not bills, because they're only looking at the mortgage payment, which is the principal and interest, the taxes and the insurance, and then people you owe money to, car loans, student loans, credit cards. They don't really care about your cell phone bill, your heating bill. They don't look at utilities. Debt is just things that you borrowed or people you owe money to. So your mortgage payment and your debt, they really don't want it to exceed 45%. And I mentioned this earlier, but this is all automated. We put everything into the loan system. You send it to either Fannie Mae or Freddie Mac, two nice names for the Federal National Mortgage Association or the Federal Home Loan Mortgage Corporation. And it comes back pass or fail. And if it says fail, you look at why it failed, you go in and you modify it. I'm just going to move this. The sun is, the sun's changing direction here and throwing my camera off. So we started doing that in the mid 90s. They call it automated underwriting, either through Fannie or Freddie. You send the file through and it says yes or no, and you just modify whatever's in there to get it to go through. But ultimately, there are some limitations on what you're going to be allowed to do, but really that number should come from the client. I'm not a fan of a lender saying, here's what I think you should spend. Most people come in with that number in their head. What I'll usually say to people is that there are two numbers you need to kind of consider. How much do you want to spend a month, and how much are you willing to part with to get there? And that's really what's going to dictate your sales price or your mortgage payment, as those two numbers, because you live in your payment. But sometimes people say, well, I really want to buy a house that's $400,000. What's that look like? And I'll go over it, and they're like, I really want to keep my payments in this range. Then I'll show them what that would reflect as a sales price. So a lot of it is just kind of figuring out what you can and can't do. It's tricky because your income changes, your debt changes, life changes. What you were comfortable spending 10 years ago isn't the same as what you're comfortable spending now. But, I never want to see someone in a house they can't sleep in at night. If you're freaking out about the payment, like, oh my God, this was the worst thing I ever did, then, you're in the wrong property. You don't want to be in there 2 years and say, oh my God, why did we buy this house that I don't like when I could have bought the house I really wanted and been comfortable? So there's a lot. Every single one's unique. There's no real rule of thumb for any of it. It's all custom. It all depends on what you're doing.
Okay.
I can tell you right now that, Bob that I work with has 4 kids. I have no kids. We spend money very differently. So there are things you have to look at outside of these rigid guidelines that a lender gives you, because they don't look at things like that and give it any weight.
Sure. It's a good point. Now, you talked earlier about sort of this historical interest rate environment we're in. And, a lot of folks are asking about, is now a good time to refinance? And, traditional refinancing, people always think, well, I can shorten up my mortgage. But, there might be other considerations there, taking money out on the equity side or reducing your monthly payment. What would you say are some factors to consider when thinking about refinancing?
So when I'm talking to my clients about refinancing, they all say, I want to save money. And I ask them what that looks like to them, because there are really 2 ways to do it. You can save money long-term by going to a shorter mortgage, which will most likely make your monthly payment go up. But now you're out of that loan sooner. The overall interest you paid is less. And sometimes people say, I just need to save money monthly. So we'll look at going back to a longer-term loan. Like the hat trick of mortgages is if you can do a reduced term and a lower payment with no closing costs. Now it's a win-win-win. You're not going backwards in any direction. I was putting a loan together the other day that fit that criteria. They had, a rate that they'd taken out, 2017, and the rates have come down to the point where they can drop their payment, shave years off the back, and do it with no closing costs. So someone with that scenario, there's absolutely zero reason not to refinance. There's no reason to keep that loan. Other people will call and they'll say, oh, I have 12 years left and I want to keep it on the remaining 12 years. And unless you have a really horrible rate, the way the math works out with the amortization, there's usually not a huge savings. I had one the other day. They had 12 years. They wanted to refi. They were going to drop their rate almost a full %, and they were going to save about $14. And they said, well, it's probably not worthwhile for us to go through this process. I'm in that position right now. I'm going back and forth deciding what I want to do with my own loan because I have a similar situation. And I've even talked to people that say, I'm considering taking money out to pay off high interest debt or even to invest into other things, whether it be retirement funds, other properties. So every single scenario is unique. It's just like, when people come to speak to you, there's no one size fits all. You have to kind of figure out what's going on with that person. Because a lot of people come in and say, I want to pay my loan off as soon as possible. Let me get in this aggressive loan. After they've taken out a 30, they go to a 50. like, oh, this is brutal. Let me go back to, I don't know, I'll do a 5-1R on a 30-year term. And then the kids get out of school and they're like, well, how about this big house? Let me get this. All right, so I had to shift my camera as the sun came through the window. So what I was mentioning earlier is a lot of times when you take out your first mortgage, you buy your first house, you're making these plans like, okay, I'm going to do this over 30 years. I'm going to save all this money or do that. And really, not many people keep a loan for 30 years. Not many people even keep a property for 30 years. My parents' generation, they're still in the same house they bought in the early 60s, where my siblings and I were all on a second or third property. It's just people don't stay in the same house as much as they used to, and they certainly don't keep a mortgage like they used to. The average lifespan of a mortgage used to be 7 years, and I would say it's probably half that now with the declining rate environment we've been in. And people use the mortgage as a tool more than they used to. They're using it to buy other properties, take cash out to do something, or do additions, or pay off debt. It's not just refinance the balance like it used to be, because you really have the two different ways you can refinance a mortgage. You can pay off that loan that you have out there, or you can take a larger loan and take equity out to do other things. And it depends on what you're planning to do with that money to decide if you want to do it long term or short term. But it's definitely not a one-time thing where you take out a mortgage and you pay it for 30 years. I had one client that was really upset because she said she didn't want to live in that house for 30 years. I said, well, you can pay it off anytime you want. And this light bulb went on. She had no idea. She thought you were signing up. You had to stay in that house for 30 years. So yeah, it's a 30-year loan, but not many of them go to term. Very unusual for a loan to last that long.
Got it. That's interesting. So if you don't mind, I want to switch gears a little bit. One of the questions that we get from clients relatively often is, what considerations should I be giving to specialty loans? And I'm thinking about, construction loans if they own a piece of land and they're going to build, maybe a second home or vacation home, if there's a rental property, even bridge loans. So what would you say are some of the considerations to be given there, whether it's on the down payment side, on the rate side, ability to borrow further?
So you're talking about a couple of different things. Most mortgages that you see there, you see advertised, they're called conforming loans or conventional loans. That's the type of mortgage that every lender out there does, every bank, every mortgage company. And you have another structure of loans called government loans. Those are VA loans for veterans. You have USDA loans for rural areas, and you have the most popular one, FHA loans, Federal Housing Administration, which is synonymous with HUD. And they all have different features to help people get into houses. Then this third category of portfolio loans, they're not using this standardized national handbook that everyone's using. So if you talk to me about a conforming loan and you talk to someone, so when you talk about types of loans, most of the loans out there are going to fall into that umbrella of conforming loans, the loans that you see every bank out there advertising. Those are your fixed rate, fixed term loans, and they do adjustable versions as well, but they call them conventional or conforming loans. And that's what most loans are. And then you have another bracket of government loans, VA for veterans, USDA for rural areas, and the most common one, FHA, Federal Housing Administration. That is a loan that has a lot of leniencies built into it. It's backed by HUD. We read a ton of FHA loans. And whether you're doing the loan with me or someone in California or someone in Utah, everyone's using a standardized handbook for conforming and government loans. So the third type of loan, portfolio loans, those are all custom. Those are lender to lender. I worked at a bank that did construction loans, and we had our own particular structure in how we did things, which was different than the bank across the street, which was different than the bank down the street. So construction loans are going to be done case by case. They're going to be customized. You might see portfolio jumbo loans. Every lender that has their own money is going to be able to do that sort of thing. You'd asked about construction loans, and people get new construction and construction loans confused. If you're buying a house that's just for sale, it's brand new construction, you're going to get a regular conforming loan. The fact that it's pre-existing or new doesn't really change much. A true construction loan is when you are borrowing, like to buy a piece of raw land and build a house from the ground up. or you own the land already and you need to borrow money to build that from the ground up. And in general, cash heavy type of loan, they want to have a large down payment on the land. They want you to have some of your own money to float through construction. But those are usually set up as a series of inspections and releases. They're not just going to give you $500,000 and say, good luck, hope you build the house. Because if you don't, the collateral doesn't support the loan that's against it. You know, this $200,000 piece of land doesn't support that house. So what you do is, as you complete your foundation, they send the guy out there. He says, yeah, it looks good. They give you some money. Then when the framing's done, they send someone out there and they say, yep, framing's up. So it's done as a series of inspection, release, till you get to the end. That way the bank is in a decent equity position. What else would you like to know? What other type of loan? I mean, then you have, this is going a little bit.
I was mentioning, you know, whether it's somebody buying a property that they intend to rent, or, you know, if somebody's going to be buying a vacation home or a secondary home. I guess, what are the considerations there? I know in terms of down payments, you know, 20% is sort of the gold standard for, you know, your primary home, but are down payment levels different at different types of homes?
They are different on the type of home and the use of the home. So sometimes people say, oh, I want to buy a second home. And what they actually mean is an investment property. So a second home should be synonymous with a vacation home. If you're buying a second home, you want to buy a house down the Cape, you go down on weekends, that's a second home. And it's going to follow most of the same guidelines as the conforming loan, slightly larger down payment. Now, an investment property, they have a higher failure rate, unfortunately, so they're considered higher risk. Because, you know, if things go sour in your life, you're not going to let your rental property stay out there while you get foreclosed on. Most people, unfortunately, let the rental property go to keep their primary. So because the foreclosure rate is higher, they want a larger down payment. And in the light of recent events, they're way pickier on proposed rental income than they used to be. It used to be you could have the appraiser go out there, they do a schedule of what they think the rent's going to be, you'd be given a certain percentage of that. I mean, right now, you know, people don't have to pay their rent, and some people aren't paying their rent. So the guidelines for rental properties are a lot tighter. Some lenders want to see you can cover this whole new note without any rental income. They will say, like, okay, do you make enough money to cover your existing bills and this new house, regardless of whether you're getting rent or not? And hopefully that'll lighten up. And that's one of those things, we call them overlays in the industry. It's an extra set of rules, and every lender has their own particular overlay regarding what they're using for rental on a new purchase. But in general, yeah, they're pretty picky about it because it's a high risk loan.
Got it. Okay. Well, George, I really appreciate you taking some time and running through some of our questions here. As I mentioned, these are our questions that we commonly get from clients. But, you know, kind of in closing here, is there anything that you would recommend that we haven't covered, or anything that you want to chat about that you think is important for the folks to know?
I think it's just, whenever you go into a conversation with a mortgage professional, if you're refinancing, decide, are you trying to save money monthly or long term? And if you're purchasing, those other two things I mentioned, how much do you really want to spend a month, and how much are you willing to part with to get there? So those two things will sort of steer you into a sales price or a loan amount.
Great.
But they're all case by case, and everyone's different. I can have this conversation 10 times today and it'll go completely different no matter who I'm talking to.
Great. Well, listen, George, I do appreciate you taking some time. I hope that was helpful for all the folks who are listening. You know, as always, with any of these types of situations, you should certainly consult with your financial advisor, your financial planner, and make sure that, you know, all the stuff makes sense for you. George, again, I appreciate you taking some time. We'll put some contact information for you at the end of the video. And to anybody listening, if you have questions, again, speak with your advisor, or certainly feel free to reach out to George directly, and he can help you get taken care of. Thanks a lot.
All right. Well, thank you, Andrew. It was nice chatting with you. And if you have any questions, you know where to find me.
Absolutely. Thanks, George.
All right. Thanks a lot.
Bye-bye.